I have been actively trading for the past 3+ years and I'm now able to make anywhere from $100 to $700 per day. But before this, I was trading without a real strategy and I did not understand the instrument I was trading, which led me to blow up so many accounts. In this video, I will share the exact instrument and strategy that I used to scale from $30 to $50 a day before going to my 9-to-5 job. This video will go over what instruments you can trade, along with the advantages and disadvantages, how and why I chose what I trade, how to use my strategy with the instrument I trade, along with tips to manage your risk. Before you start trading, you want to understand when you can trade, along with the advantages and disadvantages of the instrument you want to trade. The first one I'm going to go over is stocks. The stock market opens from 9:30 a.m. to 4 p.m. Eastern Time if you're trading the New York stock market. Advantages are it's liquid. There are a lot of participants, a lot of people trading it, and it's a regulated instrument and it's easy to understand. Disadvantages are you need a lot of capital to see returns with those liquid names that you're trading. Crypto trades 24/7, 24 hours non-stop. Main advantage is that it's very volatile. So with volatility, there's opportunity. And there are no minimum capital requirements. So you can see that a lot of people can trade Bitcoin, Ethereum. But the downside is that there are also like pump and dumps for all those smaller names that you see in the crypto market. Number three, Forex. Trades 24 and 5. Forex is the largest market with lots of participation. And when it comes to access to capital, there are prop firms that are able to fund you if you pass a challenge and you're able to follow their rules. The disadvantage of Forex is that it is not regulated. And this is the part that hurts a lot of Forex traders. They know it, but they continue to trade it. No shade. It's up to you if you want to continue to trade it. And then the spreads punish the small accounts as well. For futures, 23 and 5, that's the market hours for futures. The advantage of futures is that you have leverage. You're able to leverage and it's safe, and you have options like prop firms to give you access to capital. So you pay anywhere from like as low as even $50. These days I've been seeing you do a challenge and then evaluation you pass, you get and you get funded. The difficulty is that it's tough to hold for long periods because contracts expire and it's not as beginner friendly. There's a lot of little details that you need to learn before you can trade futures properly. Those beginners should not just jump into trading futures without learning the details. Disadvantage of trading futures is just with your own capital is the margin requirements. Obviously, when you're able to have access to prop firms, that helps. The last one on the list is options. Options trades the same hours as the New York stock market from 9:30 to 4 p.m. The advantage of options is low capital. You have the lowest barrier to entry with options and it's very liquid. And because the stock market is regulated, you're able to find liquid names to be trade and make money with small capital. The disadvantage is that you can lose money fast if you don't learn the basics well. So what did I end up picking? I decided what I was going to trade based on two things. Number one was lifestyle. I had just started working and I knew that I did not want to trade markets that were open for 24 hours a day. That was just not an option for me. So I knew that I could manage my schedule and probably just trade the first 2 hours of the New York session. And then I also didn't have a lot of capital to start with. I was investing little by little, but it just was not enough to meet certain requirements to trade or to even see meaningful gains. So, because of number two, capital gains, and number one, lifestyle, I ended up going with, you probably know, stocks, and options. So those were my two reasons. So before you decide to proceed, make sure you understand what you're trading and why and how it can fit into your life. I know I said I was trading stocks and options, but the problem I was facing with trading just stocks was that, for example, you have Nvidia and you buy Nvidia at $200. My question now is, how can I make $100? I have several options, but option one was to buy one share at $200 and then wait to sell it at $300. That's investing at that point because that move would most likely not happen within a week. It would be rare to see that kind of $100 move in a week. Or my other options were to probably have a meaningful amount of shares, like maybe look for a $1 move and buy 100 shares of Nvidia. But the capital required to do that is $20,000. Similar to if I wanted a $2 move and then I bought 50 shares and the capital I need is $10,000. You see the challenge. So now, with options though, because of how options work, I will go over what options are briefly in this video just to provide some context. But one option contract is equal to 100 shares of the stock. You're not trading the stock, you're trading a derivative of the stock, which is why you can see that if you buy 200 Nvidia 200 calls and you pay $2.50, but actually you need to multiply by 100 because what you end up paying is 250. You multiply by 100 and what you end up paying is 250 for those for one contract. But now how can you make $100? The answer is not that straightforward, but you can use 1 to 2 option contracts and you'll be able to make $100 within 2 hours of trading. There's a chance if the setup is there, but you get my point. You won't need a lot of capital. Someone with $250 or even less can make more than someone that just committed over $5,000. Okay. Now, with options, the first thing I want you to understand is that when you go onto your broker, you would have to look for the option chain. I use IBKR, Interactive Brokers. It's called IBKR, Interactive Brokers to trade. So this is what the option chain in my broker looks like. You'd have a date, which I'll explain what this date is later on in this video, and you see certain prices. That's your strike price. And then you see the bid and the ask as well, and some other numbers that I will be going over later on in this video. So you want to learn about options. Options gives you the right to buy or sell a stock at a specific price by a future date. So it does not give you the obligation. You have the right to buy or sell at a future date at a specific price point that you want. Before you start trading options, you need to know two terms, at least day trading options. You want to know what calls are. You buy a call if you think the stock price will move higher within that specific time. And you buy puts if you think the stock price will move lower within a specific time. How you can remember it is that you pick up your phone to call up and you put your phone down when you're done talking. So what is premium? Premium is basically the cost of one option contract. When you buy one option contract, you pay a premium. And then you have the contract size. One option contract represents 100 shares of the stock you purchased. Similar to what I said earlier, when you're buying one option contract, it's similar to you buying 100 shares of the stock. Expiration. Options have an expiration date, and the goal is to sell before it expires. Next is pricing. Option prices are quoted in cents, so you have to multiply by 100 to get the contract cost. And then you have the strike price. By definition, it's the price at which the option can be exercised. But because we don't want to exercise the option, we're not waiting till it expires, you can just think of it as the price you think the stock is going to get to within the window that you are trading. So if SPY is trading at 709 and you think within 1 week, it would gets to 712, this is what you can pick as your strike price. And your strike price basically is listed here on the table. You see your strike price. These numbers are strike prices. Okay. Now, before you touch options, you need to meet the Greeks and understand the Greeks. What are the Greeks? The Greeks are basically what impacts or changes your option contract price. When you go to your option chain, you will see something called delta and you have the gamma, and you need to understand those two. I would say three. I don't have data shown on mine because I don't really pay attention to it. It's so microscopic, and I've learned the ranges for the names I trade, and so I don't need to show it. But you need to know the delta, gamma, and theta if you're day trading. The other two Greeks you don't need to pay attention to. They don't really, they play a role, but it's not as significant. So let's break this down. Your delta, what does it mean? Your delta measures how much the option price changes for $1 change in the underlying price. So if I'm trading SPY and SPY goes from 702 to 703, your delta is going to change. Your premium will change. So that's what you're trading, right? You enter at 702, it goes to 703. Your delta is going to change. And you use it to help you manage risk and size your trades properly. If you have high deltas of above $40 dollars per $1 move, you want to be able to manage your position so that you don't lose more than you want to. Now, the next one is gamma. Gamma measures the changes in delta. So once your delta has changed because of this move from 702 to 703, your gamma is then going to be added onto your price. So that's how you see how options just moves really fast, and it can affect you if you hold your losers too long. Say it goes to 701, you don't sell. It moves down to 702, you don't sell. It would just be accelerating, and then that's how you lose money. And that's why I said with options you can lose money really quickly if you don't know what you're doing. And now theta, it's time decay. Because your contracts expire, you have to sell before it expires. If you're trading and your contracts expire in a day or the same day, the value of your contracts would be decreasing if the move is not happening in your favor right away. So that's why you want to avoid choppy trades where you are just in range. Your contracts will not move that well because theta is eating it up. But if you see the strong moves in your direction quickly, it would then accelerate the increase in the contracts. The increase in the contracts will move faster. So I'm going to show you at the end of this video how to manage this as a beginner. Just tips for which contracts to select so that you don't lose more than you plan to. Now, how do I trade options? First things first, you're going to analyze the stock the same way using this strategy. You mark out your previous day's high and your previous day's low. This is just one of my strategies I'm using for this example. Marking out the previous day's highs and previous day's low. And then step 2 is that you wait for price to come down to retest this previous day's high, because you've seen that, okay, before the market opened during the New York session, that this name had strength. Now you're waiting for the previous day's high retest for price to show that buyers are stepping up, and then you buy. Step number 3, you want to enter and exit the trade, but you're not buying the stock. Here you can see that buyers stepped in nicely. You got confirmation, the candle engulfed. You're now looking to enter here once the candle closes, and price is trading around 233 cents. You're not buying the stock. You now go to your option chain, and in this case, like I said, your strike price in this case, because if you look at the target, you're targeting 201.65, but if you notice, you don't have a 201 strike. So I would, best case scenario, go for the 202.5, and I'll tell you why. If you look at the delta on this contract and then you look at the gamma, if I'm somebody that say that only wants to risk $50 per trade. I don't want to lose more than $50 per trade. I'm trading a small account. Go for the 202.5s. Why? Remember what I told you about delta. For for any change in price, remember to also multiply by 100. You for any change in price, because your delta is 0.4 in this case, say $40, and your gamma is in this case 0.08, which is around $8. For any $1 move against your position, you lose 48 to $50 for any $1 move. So this now tells me that because I only want to risk $50 on this trade, this is the appropriate strike price that I would pick, the 202s. You wouldn't want, you say, but why can't I take the 200? Because it's at 200. The delta on this 200 one is $60. So you'll be losing anywhere, if you take the 200 strike, you'll be losing anywhere from 68 versus 68 to 70 versus 48 to 50. And this makes a lot of difference for some small accounts, right? Now I would pick the 202.5 because there's a high chance that you get that move into 201.66. Now you're managing risk $48, and then if it works in your favor and it moves into what 20 if it moves into 201.66, right, you would see that you would make anywhere from 48 to $50 per contract. And if it moves higher, you can then make $100 or more. That's you just trading one contract. And again, the price was bid versus ask. If you're buying the ask, $133. So you bought something. Let me wipe this. Just think about it. You bought something for $133. Your risk is $48. $48 to $50. I'll just say $50. And then you can easily, within 2 to 3 minutes, make $50 per contract. It starts to get good when you have more contracts. Say now, but then your risk also increases. Say if you have 3 contracts, so you just multiply 133 by 3, that's your cost. That's around close to $400. So you'd be looking to now make 150. The thing with options is that you need to understand what your delta is before picking contracts. I know some people say, yeah, I risk 10% of the premium, 20% of the premium. That's not true, because 10% of this 133 premium is not $48. So you're not risking 10%, you're not risking 20%, you're risking more. And that's why you need to understand what the delta of the stock that you're trading truly is. Now, I'm going to give you tips that would help you manage your risk. For beginners, avoid trading contracts that expire the same day. For the life of me, it's exciting because if it works, you get paid big. But if it doesn't work, you lose more than you planned. And that can affect your confidence. Number two, if you're day trading, take contracts that have at least 2 days until expiration. If not available, take the following Friday. Those are called weekly contracts. Options initially started with just the weeklies, the monthlies, but now you can see now like some names like Nvidia, Tesla, Apple now have Monday, Wednesday, and Friday expiration. So you should be able to at least go 1 to 2 days out at a time. On Friday, take Monday or take Wednesday. Manage your risk first. And if you're swing trading, take contracts with at least 2 weeks until expiration. I don't like when I see people with large accounts say they're swinging and they know they have a lot of people with smaller accounts following them, and they take a contract that expires in a week. Because what if that move takes a long time to happen? Because with swing trading, you're looking to capture a big move. What if the move takes a long time to happen and then you're taking a 1 week out expiration? That's not great. Like, that's not a great risk management, in my opinion. But if you can afford it, go for a month out with swing trading because you're trying to look for a bigger move. It's better to buy time so that you're able to let the trade play out and manage your risk. I'm an advocate of risk management first before thinking about profits, because if you can manage your downside, then you're not comfortable to allow your trade play out and work out in your favor. So that's it for this video. This is an introduction to options trading. If you have any questions, leave a comment below and I'll be sure to answer and provide further clarity on anything you don't understand. And let me know what you want to see next. Thank you so much for watching. I will see you on the next one.